And during that news conference with Guo Shuqing, talked about chaos across different financial watchdogs in China. My colleague Owen Fairclough spoke with the Carnegie Asia Program's Yukon Huang and asked him what that meant.
He's coming into a tough job. This is a country where debt has exploded. Borrowings of households, corporates, the government, faster than any country over the last 10 years. So that's certainly worrisome. Banks are also creating what we call, in the banking profession, sophisticated products. Not the traditional ones you see that banks have for normal households, but more risky things. And people don't quite know how serious a problem this is. Then you have a lot of what I call small and medium-sized banks in the provinces, in the cities, localities, and they're lending. And they're lending largely on demand of local governments and officials. And many of these projects are not doing very well, so the risks are building up in the system. So what he sees around him is a lot going on, and many people are concerned about the risks involved.
This will sound familiar to anybody that's read or seen The Big Short. Can we compare what's happening in China to what happened here in the US 10 years ago?
Well, some people draw that analogy, and I think that they are overblowing the risk, in fact. China's quite different, because much of this debt is state-driven, state banks lending to state borrowers, and that's quite different from a private sector-dominated banking situation. China's fortunate. Its banks can draw upon a huge household savings deposits in the banks. You don't see that in the West. So they have something which is easy to draw upon. Overall, China's financial position is very good. It has very low external debt. It has very large trade surpluses. The government has a lot of resources. So I don't see the kind of a collapse or the financial crisis that some people talk about. But there's a hemorrhaging in the system. There's a deterioration in the quality of the lending in the financial sector. And this is slowly building up. And if you don't address this, then this will have an effect upon China's growth prospects, let's say 5 years down the line or 10 years down the line. And so this needs to be dealt with right now.
In China, there are lots of disparate and very different regulators across the financial system with very entrenched interests. Surely it's going to be very difficult to try and bring them under one umbrella body or even one institution.
And that's true, because the banking activities are not simply within the normal state commercial banks. It's also insurance companies, financial intermediaries, even the stock market affects credit and financial flows. You also have to remember that there is a regulatory function which rests with the central bank, PBOC. So the question is, can he or should he be getting into the wider range of issues where they allow him to? But my guess is that he's been given this job with the mandate to try to develop a program to try to deal with this in a very broad way. So we'll have to see how large the mandate is in the coming years.
The Chinese government is trying to reduce some of this risk in the financial system by encouraging companies to do debt for equity swaps. But is there any danger that they're simply moving one problem from these companies onto retail investors?
Well, the government has been trying to reduce the debt burden in terms of its overall significance in the economy. And there are two ways that it has been trying to do this. One is, as you've indicated, convert some of this debt into equity, and then have banks and other players take on this equity holdings, and in exchange, companies' debt profile has fallen. But many people have also said this isn't going to work unless you address the fundamental question, why was the company borrowing so much? Why was the quality of its debt deteriorating? If you don't address this, then this particular debt for equity swap isn't going to succeed. The other way they've been addressing this is to try to substitute longer-term bonds with low interest rates in exchange for the short-term borrowing from the banks. But you still have the same general question. You may take off their short-term debt and their financial situation may improve, but you still have to address the longer-term issues. What are they investing in? Are these investments sensible investments that should be involved with? I think these are the issues that still need to be tackled.